Hello everyone, my name is Doug Yoder. I'm Crop Agency Manager with Country Financial. I'd like to welcome you to this webinar and thank you for tuning in. Obviously we're doing things a little different this winter. We're not able to do live meetings across the state like we typically do to give you hopefully valuable information, but we do believe that these webinars will give you access to what we feel are important updates and changes for numerous topics, and you can work with your Country Financial agent or your County Farm Bureau manager to find out where our library of pre-recorded webinars are. We're going to have a variety of topics pre-recorded on changes to crop insurance, private products, brand new private products, Farm Bill updates, since the farmers and landowners now have annual choices to make with the Farm Bill programs. We'll have some crop claims updates on claims themselves and on drone usage. We'll have a farm legacy session, and we'll also have market updates. So hopefully a very good list of topics that you can choose to tune into at your leisure. Obviously they'll be housed on a website that your agent and your County Farm Bureau manager can help you access, and you can look at these webinars at your leisure. So with this one, I'd like to go ahead and get started on describe a brand new private product that Country Financial is rolling out for 2021. It's called Added Value Enhancement. It's a new private product that I'm very excited that we're able to offer to our customers at this point in time. Before I start advancing the slides and getting into the details of AVE, as I'm going to call it, let me describe why we felt the need to bring this product to market for our customers. Obviously, federal crop insurance has turned itself easily into the cornerstones of agriculture's risk management tools for farmers and landowners. But it's also limited. Even though it's easily the #1 risk management tool, there's limitations. For example, the highest coverage level you can buy on a farm level policy is 85%. That means if you take the maximum coverage, it leaves you a minimum of a 15% deductible. That means you have to lose 15% of your farm's yield and or revenue before a claim kicks in. The other deductible, as I like to call it, is tied to the commodity prices. As you're well aware, federal crop insurance policies use the February average of December corn futures, the February average of November bean futures to establish your initial price that they use to give you your initial crop insurance guarantee. Now, if that February average is high enough to give you sufficient crop insurance coverage, that's wonderful. Regrettably, though, in the last 4 or 5 years in the environment we've been in agriculture, that February price has not been high enough to give you or your lender sufficient coverage. That's brought about new interest and demand from our customers wanting and needing to buy extra coverage. Now, obviously, not everyone's in the same boat. Not every customer in Illinois obviously is looking for extra coverage, but we're in an environment where some want it, some need it, or their lenders are requiring it. So that's why we're going down this path, and this new product that we're rolling out this year helps you, if you need to, address that low commodity price and increase your grain marketing commodity price that we use to calculate your guarantee. And I'm very excited about this new tool, Added Value Enhancement. Obviously, your Country Financial agent will be able to walk you through this in more depth, walk you through your options as far as coverage and what it would cost you. My goal today is just to describe this new tool in general to help you get an understanding of how it works, so when you meet with your agent, you'll have a better understanding, you can have a more meaningful dialogue with your agent to see how this tool could possibly work for you and what it would cost. So this slide here, I'm just going to quickly walk through some of the other advantages that Country Financial has been very serious about rolling out. Some very nice new features you can see there on your screen. The one I want to talk to today is one of our 2 private products that we use to give you enhanced coverage on top of your federal crop insurance policy. Soil Type Plus is one that we rolled out several years ago that allows you to add extra coverage, 5% or 10% extra coverage on top of your federal crop insurance policies, reducing your deductible. The other one that we're rolling out here in 2021, as I mentioned, is called Added Value Enhancement, AVE for short. That's what I'm going to be walking through here right now. So let's get started. This slide here lists what I would call all 4 options that you have working with your Country Financial agents for additional coverage. First 2 listed, SCO and ECO, are offered through the Federal Crop Insurance Program, part of the RMA Federal Crop Insurance suite of tools. The bottom 2 are Country Financial private products, Soil Type Plus, and Added Value Enhancement. Now, if you're interested in all 4 of these, learning more about all 4 of these, we also have a pre-recorded video a webinar where I walk through all 4 of these one after the other to give you an example, an illustration of how they're all different. They all attack this slightly differently. For example, the top two offered through the government are county-based coverage you can add on top of your farm level coverage. The bottom two that Country Financial is offering you are extra coverage you can build on top of your farm level production. So they're more farm level policies, which is typically what farmers and landowners in Illinois prefer. So this first one, again, STP, we have a separate webinar if you want to learn more about that one. As I mentioned, it provides you 5 or 10% extra coverage. As comparison to this new one, AVE, does not give you an extra 5 or 10% coverage on top of your federal crop. It allows you to increase your coverage within the federal crop policy that you already purchased, okay? By allowing you to increase that grain commodity price that we use to calculate your guarantee. You increase that grain price, gives you increased coverage, gives you increased guarantee, which has been the problem here in the last 4 or 5 years, as I mentioned. It's designed to work in conjunction with the underlying federal crop insurance policy, RP with the harvest price exclusion, or YP. In my opinion, it's very flexible, and I'll illustrate how that is here in a minute, why I say that. It allows you to, as I mentioned, increase the grain price used to calculate your guarantee with no speculation involved. I know that there's some other private products available in the marketplace where instead of the February price average that the federal government offers, some of the other private products offer you the higher of December, January, or February, for example. That's fine, but that only works if December or January give you a good price opportunity and better than the February average, for example. AVE, it doesn't matter what the market is trading at, what the average in any of the month is. You simply tell us how much extra grain price you want, and I'll illustrate how that is and how simple that is here coming up. So it provides an extra coverage band. You tell us how many bushels of this extra price protection you want, and you tell us how much of that additional price protection you want. It's available for corn and soybeans here in crop year 2021. It will be available for winter wheat a year from now for the 2022 crop year. So again, it works in conjunction with the underlying policy. So if you take basic, optional, or enterprise unit with your underlying policy, that's what what AVE will use as well. We will use your underlying federal crop policy to begin the process of establishing your supplemental coverage and that price election, and I'll show you how that works here in a minute. So it begins at the top of your coverage band, wherever your underlying crop insurance policy kicks in. That's where AVE starts and works downward from there in a band of bushels that you select. Again, this is available up until sales closing date for if you're talking corn and soybeans, that's March 15th of 2021. You would need to purchase it by then. We will bill you the premium for this extra coverage at the same time we bill you for federal crop insurance. So here's where the flexibility comes in. You as a purchaser, farmer, or landowner that wants this coverage, 2 simple steps. First of all, you will tell us how big that band of extra bushel coverage you want it to be. Step 2, you tell us how much extra price you want on that band of bushels, and that's it. And I'll show you how that works. So again, this chart here shows you the options you have on how much extra coverage, band of bushel coverage you want, which is dependent upon which federal crop coverage level you purchase. So on the left on this table, you'll see the various coverage levels starting at 85%, the maximum on an RP policy, going all the way down to 50%. The right part of this table shows you the available coverage bands with AVE. So for example, if you buy the maximum 85% RP coverage level, you'll see on the right that you can buy the extra band of coverage on 5%, 10%, 15%, all the way up to 35%. You can see that this is available in 5% increments and so on. If you buy 80% RP coverage, then you're limited to anywhere from 5 to 30% band of coverage on an AVE. So that's step 1. Let's illustrate that graphically. You'll see on the right-hand side of this graph is bushels, your APH, anywhere from 100 up to 200. On the left is coverage level. So let's say that top line is your farm's 200 bushel APH, okay? That's what that green column represents. The gray column next to it is your RP policy. Let's say you take the maximum RP policy of 85%. You'll see that's on the left-hand axis, 85% RP. That equates to 170 bushel trigger on the RP policy. 200 bushel APH times 85% is 170 bushels, which is protected under your RP policy in this example. Now, the columns to the right of that RP policy are your extra supplemental bands of insurance you can purchase if you so choose with AVE. So the first one, light gray, you can see it has a 10, the number 10 in it. That means if you buy 5% AVE protection, that'd start at 85% of your coverage band down to 80%. 5% on 200 bushel APH, that's 10 bushels of added coverage you can select. The next one in green is 20 bushels. You take 10% of AVE coverage, that's 10% on 200 bushel APH. You can select 20 bushels of extra coverage, and so on. You can see that this graph runs out with 50 bushels of coverage. You can even buy more than that if you want, because if you remember, you can buy up to 35% coverage bands with AVE. So this just graphically illustrates how and where the extra coverage kicks in. It's not over and above your RP policy. It's protecting the band of bushels below that trigger on RP, and you decide how big that band of bushels is. And the way I like to think about this is your riskiest bushels. These are the bushels that will trigger a claim first. Now, one nice part about the flexibility of AVE, you may want a large band of bushels with extra price protection. You may not. Some of you may choose you only want to add extra price protection on your riskiest bushels. Those bushels that obviously would trigger a claim first, those bushels that you may not be comfortable marketing ahead of time because they are your riskiest bushels. So there's step one. Step two is you simply tell us how much price coverage you want on that band of bushels. Very simple. As I've already mentioned, your underlying federal crop policies use the February average of December corn futures, the February average of November bean futures to establish your initial price guarantee on your federal crop policies. Then AVE simply offers you 5% increments of that price, up to a maximum of 25% of whatever that February price turns out to be. So let's take a look at an example. Let's say that the February 2021 average turns out to be $4 a bushel on corn. If you take 5% of that for AVE at a minimum, that's 20 cents of extra price protection per bushel you would get on whatever band of coverage you select, and so forth. 10% of $4 is 40 cents. If you go all the way up to the maximum 25% price selection on $4 corn, we would give you $1 per bushel extra price coverage on your corn policy. Soybeans, let's take an example of $10 beans for easy math. 5% of that would give you 50 cents a bushel. All the way up to the maximum of 25% price selection on the max side, you could get $2.50 extra coverage on the band of bushels on your soybean policies if you so choose. So again, you can see that none of this is tied to the market other than that February price average. We're not relying on the market to say how much extra coverage you can get. You simply decide by percentage how much of that February price additional price coverage you want. Very simple. Let's walk through an example using those two steps. First part of this table, let's build your underlying RP policy. You can see in this example, I chose a farm with 200 bushel APH. I chose that they're purchasing an 85% RP policy. Let's say the February average is $3.88. That may ring a bell. That's exactly what the 2020 February average was. So what I'm doing with this example is trying to be as realistic as I can. I'm going back in time saying if AVE was available last year in 2020, this is exactly how it would have worked for you if you chose to use it. So I'm using the $3.88 price that federal crop offered you a year ago. So 200 bushel APH times your 85% coverage level times 388. RP would have given you a guarantee last year of $659.60, as you can see on that. Bottom part of this table, we're going to build the extra coverage with AVE. So the first step of that is you deciding what band of bushels you want covered. You can see in this example I chose 15%. 15% of your 200 bushel APH is 30 bushels. That's the band of bushels that you're covering. So again, 200 bushels times 85% RP coverage, your trigger with RP is 170. You just bought 30 bushels of extra coverage, so that covers 170 bushel trigger down to 140 bushels. That's the 30 bushel band of coverage that you're choosing to give extra price protection to. Then step two is choosing that extra price coverage or the price selection. You tell us what percent of that 388 you want as additional price. You can see in this example I chose 20%. 20% of that 388 price is 78 cents a bushel. So in that 30 bushel band, you're going to get 78 cents additional price coverage over and above that February average of 388. 30 bushels times 78 cents, you're getting $23.40 extra coverage on that band of bushels, okay? So remember I said that I'd try to make this as realistic as possible. So what you're looking at now is what that premium would have cost a Champaign County, Illinois farmer a year ago if they purchased this. Now obviously, your premiums are going to vary from this example. This is a live example of what a farmer in Champaign County last year would have had as a premium on 200 bushel corn, 200 bushel APH with an RP policy using enterprise units. Obviously, your premium is going to depend on which county you're in, what your APH is, which policy you're buying, and so on and so forth. This is a live example of what it would have cost that farmer in Champaign County a year ago. You can see on the left-hand part of this table in green the coverage band elections anywhere from 5% to 35%. You can see the green bar going across the top horizontally is your price election anywhere from 5% up to 25%. So if I start, and you can see all the various options here and how flexible this is, and that you can mix and match the coverage band and the price to determine how much coverage and how much you want to spend. So if I start with the minimum, if we go to the top left corner and choose the minimum coverage band election of 5%, the minimum price election of 5%, you can see it would have cost 45 cents an acre last year in Champaign County in this example. Very cost effective. If I go to the very bottom right and I maximize the 35% coverage band and I maximize the 25% price election, you can see the maximum would have cost that farmer $6.93 last year. And then everywhere in between, you can see I just outlined the minimum and the maximum it would have cost a year ago. Now this table goes one step further. This table takes all of those premiums we just showed you and adds to it how much extra coverage you would have received for that, okay? So same outline, extra coverage band down the left column in green, extra price election across the top in green. Again, if I start on the upper left and show you the minimum, 5% coverage band, 5% price election, that was that 45 cents premium we just talked about. That would have given that farmer an extra $1.90 in added coverage last year for 45 cents. Let's go to the maximum. Go down to the bottom right. We take 35% coverage band, 25% price election. As we just showed you in the previous slide, that would have cost that Champaign County farmer $6.93 an acre. They would have received $67.90 an acre extra coverage. So in my opinion, everyone's different on this, but in my opinion, $6.93 premium for $68 of extra coverage is very affordable. I think we're going to have a lot of farmers interested in at least taking a good hard look at this with their agents. Now let's look at the example I had already built. In that example, you remember I chose 15% coverage band on the left, 20% price election across the top. You find that intersection in the table, $4.07 premium for that $23 in extra price is the correlation there from price to extra coverage. So again, your premiums are going to vary, but you can see, as using this as an example, I think this is cost affordable enough we're going to have a lot of interest in this. Now again, me saying that really depends on what that February average turns out to be. If February average turns out to be nice and high this year, then we may not need this product, right? If February average remains low, especially like it's been the last 4 or 5 years, I'm pretty confident we're going to have a lot of farmers at least want to investigate this new tool and see what it can do for them. So let's walk through that example graphically. Let's say that top green bar I just put on this slide represents your expected farm revenue. Let's say you have 200 bushel APH. Let's assume that the February average in February 2021 turned out to be $4. 200 bushel APH times $4 is $800 of expected farm revenue, but you can't protect all of that, right? First of all, you're only going to get, you have your deductible that we're going to build here. So on the first column here on the left, I'm going to choose 85% RP, the maximum RP available, but no AVE. As we just described in that example, as we calculated in that example, 200 bushel APH times 85% times a $3.88 price gives you $659.60 guarantee. Well, if you're expecting $800 revenue and you can only guarantee $659, that's $140 of deductible numerically. Just put a number on that deductible. Now this next column, let's combine RP with AVE. So the RP part is still the same, still 85% coverage level, still $659 worth of guarantee, same RP deductible. But now let's add AVE. So again, you can see that AVE starts at your trigger, in this case 85%, and goes downward from there based on how big a band of bushels you want to cover. In that example we showed you, we calculated the bushels times the price selection was $23.40 worth of extra coverage you're getting there on that band of bushels from AVE. So that's just visually how that example built out, how it would look. So now let's look at some examples of combining RP and AVE with some possible harvest scenarios. So let's say harvest scenario number one, we had 150 bushel yield on that farm. Let's say the price did not change. Let's stay at $3.88. So let's calculate that harvest revenue, 150 bushel yield on that farm times 388. You would have actual harvest revenue, how crop insurance calculates it, of $582. You had a $660. If you back up a few slides, our RP guarantee was $660. Subtract the $582 harvest revenue, you came up short of your guarantee, so RP would trigger a $78 claim. Now let's build your AVE claim. You had a 170 bushel trigger. You purchased 78 cents of extra coverage. That's $132 of revenue trigger on AVE. Take the harvest revenue of 150 bushels times that 78 cents you purchased. That's 117 of actual harvest revenue. How AVE would calculate it, that's less than your $133, if I round it up, of your AVE trigger. So AVE would owe you a $16 claim. In this example, you get both. You would get a $78 RP claim, you would get a $16 AVE claim. We would pay you a total combined claim then of $94, okay? Example number two, I'm going to build in a price decline. From the February average to the harvest price, when they remeasure it in October, the price has gone down. Show you how that would work. So again, same harvest yield of 150 bushels, but now the price has dropped to $375. That gives you a harvest revenue of $562.50. Again, that's below your $660 guarantee that RP provided you. So RP would trigger a claim of $97.50 in this example. We build the exact same AVE, 170 trigger times the 78 cents you bought. But now we calculate the harvest price, AVE, supplemental harvest price, $375 October average times the 20% price selection you chose. That's 75 cents of AVE harvest price protection. Take your yield of 150 times that 75 cents. That's harvest revenue on how AVE would calculate it of $112.50. So that's below your trigger. So AVE would trigger a $20.10 claim in this example. Again, you get them both. $97.50 claim from RP, $20.10 claim from AVE. We'd pay you a combined claim of $117.60. Third example, let's say the price goes up. And the reason I built this example, included this example, is this is an RP example. And as you know, when you buy revenue protection with federal crop insurance, it gives you the higher of the February average or the October average, whichever one is higher. So in this example, if the harvest price has gone up, we will recalculate your guarantee using that higher price. So in this example, we'll stick with that 150 bushel harvest yield for this farm, but let's say the October average rallied to $3.99, higher than the February average, so we will calculate a new revenue protection, new RP guarantee, 200 APH times 85% coverage level times $3.99, now gives you a new guarantee of $678.30. Actual harvest revenue, 150 yield times your October price of $3.99, $598.50, that's below your new RP guarantee by $80. RP would trigger an $80 claim in this example. Let's calculate how AVE works in a price increase scenario then. Supplemental price, we use the harvest price of $3.99. You chose 20% price election. That's 80 cents a bushel now. So the supplemental price has gone up since our harvest price has gone up. AVE trigger of 170 bushels times the AVE price election of 80 cents a bushel is $136 of revenue trigger on AVE. Calculate your harvest revenue then, 150 bushels times your 80 cents of extra protection is $120. That's $16 below your revenue trigger, so AVE would issue a $16 claim. $80 RP claim combined with a $16 AVE claim, total combined claim then of $96. Now one point I want to issue here, if you're comparing how AVE works with some of the government's offerings on added coverage such as SCO or ECO, those are both county-based products. So your RP claim, when you combine it with SCO or ECO, we'll get you your RP claim as soon as you're done harvesting, turn in your records, and our adjusters do their work, calculate your claim. You can get that claim check in November, December, depending on your timing when you're done with harvest. On SCO and ECO, since those are county-based supplements, you won't get that claim check if there's one until the following June. On area-based, county-based products that the government offers now, including SCO and ECO, they don't publish the numbers and we can't issue a claim until the following June, so there's a delay. On AVE, since it's tied to your personal production, we'll issue that AVE check similar timing that we issue the RP check, so much quicker obviously. Look at some examples. I've already walked through some of these, but let's just list them. You have control. You decide how big that band of coverage is you want. You decide how much extra price protection you want on that band of protection. Very flexible. Again, you decide. It's not dependent upon a market rally to say how much extra price. You simply tell us how much extra price you want. I hope it's fairly easy to understand, especially after you hopefully listen to this presentation, talk to your agent about it. I think it's very affordable compared to some other private products. It's very flexible. You can tailor it to fit your budget or how much extra coverage you want. And obviously it's going to work in conjunction with your underlying federal crop. Now I think there's an extra advantage I'd like to talk about, potential advantage I'd like to talk about. Those of you that know me and have listened to me talk about crop insurance for quite a while now probably remember that the only reason I ever started to care and learn about crop insurance is the added benefit it gave us on the grain marketing side. Prior to 1998, the only coverage you could buy with federal crop insurance was yield-only coverage. Not many Illinois farmers used it, and those that bought it had really low coverage levels. They weren't getting claims very often. 1998, the crop insurance world took a significant step in improvement. They offered revenue-based coverage. They added a grain price to your yield coverage, gave you revenue-based protection, and completely changed how farmers and landowners viewed crop insurance. We see a lot more policies now. We see a lot more coverage levels. If you want the numbers, last year about 85% of every planted acre of corn and soybeans in Illinois used crop insurance. If I look at what policies Illinois farmers and landowners are buying, over 94% of them are farm level coverage. The maximum of that is RP. RP is easily the most popular choice, and the most popular coverage level is 85% statewide, the maximum. So farmers have really, and landowners have really turned crop insurance into their main risk management tool. Again, one reason I think that is the advantage it gives you on the grain marketing side. Now, people's grain marketing likelihoods are completely separate, very, very individualized. Some people are more willing to go out on that risk limb and sell expected production ahead of harvest if the market gives you a rally and a nice price. Others simply aren't and never will be, and then everywhere in between. So let's build some possible scenarios here and how I think AVE, if you're so inclined, can provide you a grain marketing advantage, even over and above the possible extra coverage and extra claims experience on the crop insurance side. I just want to look at possible grain marketing advantages. So that top line I just drew there on that chart, let's say that represents your farm's trend yield. That's what you expect to grow in 2021. Look at your yield history over time and how it trends up. This is what you expect to grow, produce in 2021. That's not what you can insure though. Crop insurance uses a 10-year history of your yields to come up with your APH. So there's always going to be a lag. What you produced 10 years ago, 9 years ago, 8 years ago, isn't what you expect to grow in 2021. There's going to be a gap between your expected production and what you can insure using your APH. And then below that, the maximum coverage level, as I mentioned, is 85% on a farm level policy. So that's another deductible in my opinion, is you can't insure your entire APH. You can only insure, in this example, the max of 85%. So now let's start building some possible grain marketing scenarios. And again, I'm just going to use generalities. I know this is very individualized depending on who I'm talking to. Do you have on-farm storage or not? Are you willing to look at forward contracts and puts and calls and so on and so forth? Are you willing to look at hedging, things like that? Some of you are, some of you aren't. So this is just going to be a very general discussion. But when I build a scenario, first of all, with no crop insurance, you have no protection, I think it really limits to how many bushels I see you willing to forward contract, forward market in some fashion ahead of harvest since you don't have any protection. And that's going to vary. Some of you tell me you will never market, if you don't have crop insurance, you wouldn't market a single bushel ahead of when you harvest it. Others, let's say in generalities, maybe you're willing to market at 25% ahead of time. Now, I know there's some of you out there that will sell even more than that, market more than that ahead of harvest if it's a good price offered to you from the market. But in generalities, this is kind of how I see it. That leaves a lot of red on top. That red bar represents your unpriced, unprotected, at-risk bushels. That's a lot of bushels you're heading into harvest time, need to find a home for. Either store it on the farm or take it to an elevator and either sell it with the cash price or pay them their storage rates, hoping for a rally later. That's a lot of unprotected, unpriced bushels. Now let's add in an RP 85% policy. Again, even though everybody's different, when you purchase that RP policy, I truly believe a lot of farmers buy that for grain marketing advantages. You can expand the number of bushels you can safely sell or forward market ahead of harvest if the market gives you that opportunity. If the market doesn't give you an opportunity, then this doesn't matter. But if we see a rally in June, July, August due to weather, let's say, or something happening around the world and the market does rally and give you a profitable price, a lot of you are more willing to lock in more meaningful bushels when you have that crop insurance protection in your back pocket. Okay? So then above that you would have a yellow band that I call protected. They're still protected by RP, but you haven't marketed them, so they're still unpriced. Then above that you still have your at-risk bushels, no protection with crop insurance, no marketing protection, so they're truly at risk. Now let's take the final step. Let's take RP at the max, 85%, and now let's add AVE. Since you're able with AVE to target that riskiest band of your production at the top of your coverage level and decide how much extra price, in my opinion, if the market gives you that opportunity ahead of harvest, that should give you the comfort to step out on that risk limb a little further and sell even more meaningful bushels ahead of harvest if the market gives you that opportunity at a preferable price, because you've already added to your grain marketing guarantee through AVE. So if the market rallies after you marketed it and you've got to cancel some contracts at the elevator and you owe money to the elevator since you can't deliver all those bushels, let's say due to a drought, your crop insurance is going to offset that risk by giving you a bigger claim because you've already added to your grain price, and RP uses the higher October average. That's why that's built that way. So in that world, in that scenario, I think that increases the number of bushels that you have protected, reduces your yellow band there that's protected but unpriced. Now your red band would still be the same in this scenario. You still have that red band on top that's unpriced, unprotected, unless you're willing to look at another product that attacks that deductible and lets you shrink that deductible. And the tool that we offered for that is called STP, Soil Type Plus. It gives you an extra 5 or 10% coverage on top of your underlying crop insurance deductible or protection. So that's how you can even attack that red band if you want. We have separate webinars describing how STP works if you're interested. So let's talk about some exclusions. We cannot offer AVE coverage on high-risk land or any land that's unclassified or unrated by the government. If you have high-risk ground that's insured under a written agreement, that doesn't apply to AVE. And if they have certain types of crops and or practices not offered coverage under federal crop, then we can't offer that with AVE either. There's no prevent plant or replant coverage with AVE. So that's AVE in a nutshell. I hope that helps you understand this new product and why you may want to get it, investigate it with your agent. I encourage you to do so. I think it's very flexible. I think it can attack the problem we've been having of low grain prices, which then lead to low guarantees and not sufficient guarantees to satisfy you or your lender. So here are the last few slides. I'm just going to quickly walk through some other things I want to make sure you're aware of so you can talk to your agent about. Some other advantages and tools and services that Country Financial has been very serious about adding to our toolbox of options for you to consider. I've just walked through AVE. As I mentioned, you can look at a Soil Type Plus webinar as well. Another new advantage we rolled out in 2020, we increased our replant coverage statewide. If you buy our crop hail product and you want extra replant coverage, we expanded that to $65 an acre. Previously, our max you could buy was $45 an acre. Last year, we rolled out $65 an acre replant to every county in Illinois. In addition to that, last year in 2020, in a 13-county pilot area in southern Illinois, we offered that $65 acre replant for $2 an acre. Very, very affordable coverage. Worked wonderfully down there. A lot of farmers took advantage of it. It's so popular, we've now expanded that to the entire state. So now in 2021, you can buy that $65 an acre replant coverage if you want, for $2 an acre. Several years ago, we enhanced our replant coverage on soybeans. When you buy a federal crop insurance policy through the government, they establish an initial planting date in every county. They do that because of replant and prevent plant. So that date says if you plant soybeans after that date in your county, you're eligible for the federal crop insurance replant provision. If you plant beans earlier than that date in your county, you're not eligible for the federal crop insurance replant provision and assistance. We can't change the federal government's date, but we changed it on the extra replant you buy from us on our crop hail. We gave you 2 additional weeks. So now whatever that initial plant date is in your county, you can now plant beans 2 weeks earlier than that and still qualify for our replant provision on our hail side if you purchase it from us. Last year we launched a brand new bundle discount. If you buy both wind and replant coverage from us on corn, we'll knock 10% off both premiums, the combined premiums. Last year we revamped our early pay discounts on crop hail. We increased the biggest discount. It's now 8%. If you purchase your crop hail from us by March 28th and pay the bill by end of April, you will save 8% off your total bill. Second discount is 4%. If you purchase it by June 28th, pay it by the end of July, you can save 4%. So we increase that top discount. We have premium volume discounts. We have group discounts. Again, talk to your agents if you want more details on all of this. Several years ago, we increased the amount of coverage you can purchase on the grain that you're storing on the farm. We were getting requests from our customers. They simply wanted and needed to purchase additional grain coverage on stored grain, so we did that. This one, bottom one, is brand new for 2021. If you buy a farm policy from us and a crop hail policy from us, we're launching a brand new 6% discount on that combined policies. So a new discount there, new increased discount there, I should say. Quick word on crop claims. Do a fantastic job, in my opinion, second to none. It's a true advantage that our company offers our customers, in my opinion. You take a look at this sub-bullet point. In 2020, all of our customers that had a claim and filled out a customer survey card, 99.9% of them were satisfied with our service. That's fantastic. And when you have a claim in rough times, you want to make sure it's fast, it's efficient, it's fair. You can see that our claims adjusters are doing a fantastic job. They use drones to survey your flooded areas, your drowned out spots, things like that. They use them for tornado damage, for wind damage. Very efficient way to increase, improve what our adjusters do. It speeds it up and so forth. They cut hail claim checks right on the spot in many cases. They also offer non-loss APH certification. That means that even in a year you don't have a claim, our adjusters will come out, and if you want them to, for free, they will certify your production for that year. That is huge peace of mind if you're ever audited by the federal government. If you already had your production certified by a certified adjuster, then you're going to sleep much better at night during that audit. And it also can lead to advantages such as increasing your APH over time. If you want them to, our adjusters will start with your wet bushels off your settlement sheets, let's say from your grain elevator, and when they readjust it using the government's factor for shrink, moisture shrink, 1.2, RMA for crop insurance uses a 1.2 shrink factor to shrink your bushels down due to moisture. Most of your grain elevators use a 1.4% shrink factor. So if we adjust your bushels this way, you're going to end up with more bushels year after year after year that they do this certification for you. You keep doing that over time, your APH is going to grow, your guarantee keeps going up because of that higher APH. Wonderful offering in my opinion, and it's free. Something I'd encourage you to think about, talk to your agent about, talk to your adjuster about if you're not doing that already. So with that, I thank you for tuning in, and again, please talk to your country financial agent, crop agent, or crop specialist, or your county farm bureau manager. They can get you the location of where we're housing numerous other webinars such as this if you want other information on some of the other topics that we feel important for you entering the 2021 crop year. Thank you very much for paying attention.